back to the Options Academy. In this presentation, we'll discuss selling credit spreads. As always, to make the most of this presentation, we recommend that you refer to our written article at www.theoptionsacademy.com, which matches this video. In this presentation, we will discuss moving on from selling naked options with unlimited risk to selling credit spreads, which are a limited risk strategy. Moving on from naked options to credit spreads requires a shift in perception. It is a shift that a sprint runner would make if she or he would start practicing for a marathon. It's a shift a softball player would make if he or she decides to concentrate on base hits rather than home runs. In its base, selling credit spreads rather than naked options means giving up some of the speed and thrill of potential, and in return achieving more staying power and much less risk of falling breathless before the race ends or being struck out. As in many things we do here too, there is a give and take. Selling a credit spread means taking a large portion of the premium we collect when selling an option and using this premium to buy another option further away from where the underlying market is currently trading. It ultimately means taking less potential profit and in return gaining less potential loss. Let's look at an example using the same option we sold as a naked option in the naked options presentation. The S&P 500 1375 call. We sold the 1375 call and collected $1,000. As we witnessed, this naked position carries unlimited risk. In order to limit the risk, we will create a spread, giving away some credit, but nonetheless remaining in our position as net creditors. To create a spread, we simply buy a call option further away above the market. For example, the 1400 call. The 1400 call is cheaper than the 1375 call because it is more distance from the current market level. Let's say that again. The premium we collect from the sale of the 1375 call is greater than the premium we have to pay for the purchase of the 1400 call, therefore leaving us with credit in our hands. If we sold the 1375 for $1,000 and bought the 1400 for $500, we will collect a credit of $500. It is important to understand this credit does not belong to us yet. We will keep it if and only if at expiration the market settles below 1375 and the spread expires worthless. Remember, the goal of a naked option seller is for the option to expire worthless. The same goal remains when selling a credit spread. The goal of the seller is for the spread, the entire spread, to expire worthless. The short option, the long option, the whole 9 yards expire worthless. Once the spread expires worthless in its entirety, the seller gets to keep the premium collected at inception. Now, here's one really neat thing about the credit spread. Once you've created the credit spread, you are limiting your risk without the need to put a stop or take any further action. This is a built-in limit in your trade. As long as you don't break the spread, that is, as long as you don't buy back the short leg only or sell off the long leg only, and as long as the market at expiration is above or below the spread, your risk is limited. And again, this is where you may find it useful to refer to the matching written article on our site. Let's take a look at a scenario in which the market moves adversely to your position and expires all the way up to 1425. The 1375 call is worth 50 points. 1425 minus 1375 equals 50. The 1400 call is worth 25 points. 1425 minus 1400 equals 25. The premium you collect equals 2 points. Collecting 4 points for the 1375 call option you sold and paying 2 points for the 1400 call option you bought. The total loss then would be 50 minus 25 minus 2 equals 23 points, or $5,750. Let's see what happens if the market expires even higher at 1475. The 1375 call is worth 100 points. 1475 minus 1375 equals 100. The 1400 call is worth 75 points. 1475 minus 1400 equals 75. The premium you collected equals 2 points. We always get to keep it. The total loss would be 100 minus 75 minus 2 equals 23 points, or $5,750. No matter where the market goes, and no matter how seriously your market prediction is wrong, this specific spread's worst case scenario is $5,750. At expiration, the market could trade 10 points above the spread or 100 points above the spread. The maximum risk will always remain the same. Another good thing to remember about the spread and about its maximum risk is this. Prior to expiration, the spread is never worth its full value against you. The maximum potential loss will manifest itself only if the spread is completely in the money and at expiration. The reason for this phenomenon can be explained and understood by reading and watching our Delta article and presentation. Prior to expiration, because of the nature of options and their relationship to time value and to the underlying market, the option spread will always be worth less than its full value. Granted that if the spread is fully deep in the money and near expiration, the difference between the full risk and the manifested risk might be minute, but nonetheless, it exists. And more, because the spread never trades its full value prior to expiration. The spread trader gains a lot of flexibility in managing the risk on the trade prior to expiration. As a side note, to those of you who have been trading spreads for a while, this is one of the reasons why we recommend not holding a credit spread until expiration and exiting the position before expiration. There's some more good news for those of you who wish to lower the risk on your spread. It is easy and simple to control and predetermine your risk by making your spread wider or narrower. A 15-point spread, 1375 by 1390, for example, would carry a maximum risk of $3,750 less the premium you collected. 15 by 250 equals $3,750. A 10-point spread, 1390 by 1400, for example, would carry a maximum risk of $2,500 less premium collected, and so on. The risk is predefined to the distance between the strikes. By manipulating the width of the spread, the risk could be controlled with little effort. Working with spreads allows the investor to tailor risk-reward potential with one decision. Limiting risk is not the only advantage of a credit spread. The implications on margin requirements and staying power are significant. Structuring your risk with credit spreads provides an answer to the market moves that occur between the inception of the trade and its expiration. If the underlying market moves against your position, the short option, the one you sold, gains value against you, but the long option, the one you bought, gains value as well, offsetting a very significant part of the short option loss, provided, of course, that the spread you structured is not too wide. This credit spread behavior provides you with the psychological and practical advantages that are not at hand when trading naked options. Another important benefit of the credit spread is its lower margin requirement. Margin requirement is directly influenced by the risk of any given position and the funds you have in your account. When selling naked options, your risk is virtually unlimited, which in turn increases the margin required to hold the position. When an underlying market moves against your position, a naked option gains value against you, which means your account is reducing in value. The combination of high margin on a naked position and decreasing funds in an account is what often forces traders out of a trade. Credit spreads offer a different scenario. As the option you own gains value in your favor, your loss is mitigated and your account may not suffer the same shortfall experiences with a naked option. As for the risk, the margin system perceives the spread as less dangerous than a naked option, instantly rewarding you with lower requirements and higher staying power. Selling put credit spreads is no different than selling call spreads. If your outlook on the market is bullish rather than bearish, you could sell a put spread. The mechanism and principles are identical. By selling a far out of the money put spread, you will collect premium, allow yourself a large margin for error in the event that your outlook proves incorrect, and create a built-in limited risk in your trade. Let's look at an example. Selling the S&P 700 by 675 put spread, selling the 700 put and buying the 675 put, we collect 4 points or $1,000. Should the market be above 700 at expiration, both options will expire worthless, making the trade and you a winner. Should the market tumble down, the spread will provide a limited risk profile similar to the spread we examined on the call side. The maximum loss on this put spread is predefined to 25 points less the 4 points of premium collected at inception. At 20 points put spread, 700 by 680 put spread will carry a maximum risk of 20 points less the premium collected, and a 10-point spread, 700 by 690, will carry a total risk of $2,500, 10 times $250, less the premium collected. To be perfectly clear, let's look at the 10-point spread, 700 by 690, for which we assume to collect 2 points and examine 2 scenarios. At expiration, the market is trading at 680, 10 points below our spread. 700 put is worth 20 points. 700 minus 680 equals 20. The 690 put is worth 10 points. 690 minus 680 equals 10. The premium we collect, 2 points. You always get to keep it. The total loss will be 20 minus 10 minus 2 equals 8 points or $2,000. At expiration, the market is trading at 650, 50 points below our spread. 700 put is worth 50 points. 700 minus 650 equals 50. The 690 put is worth 40 points. 690 minus 50 equals 40. The premium we collect equals 2 points. We always get to keep it. The total loss would be 50 minus 40 minus 2 equals 8 points or $2,000. As you can see, there is no difference in the behavior of a put spread and a call spread. Both offer the same advantages: margin for error in the form of distance from money. If you sell out of the money options, low margin requirements. The margin on a 10-point spread, which is sold 10% out of the money, may be as low as $650. Predefined limited risk profile, staying power, and the psychological vantage point to judge situations and positions that only peace of mind can provide. And with that note, we are concluding our credit spreads presentation. Please call us if you have any questions at all, and we hope you'll enjoy our next presentation, which is about iron condors and delta neutral trading. Here's to your success, and remember, there is substantial risk of loss in trading future options. Remember that past performance is not necessarily indicative of future results, and remember that only risk capital should be used.